Hello, we want to welcome you to another edition of Marty and Ted Talking Taxes. I'm Ted Perkins, and with me, of course, as always, is my partner, Marty Pezzner. We're from the law firm of Gibson and Perkins in Media, Pennsylvania. Just as an aside, this podcast will be archived on Gibson Perkins' website, www.gibperk.com. We also have some written materials that you can access on that website, on that same web page, that fill in some of the details of the topics we're going to be discussing today. Our topic for today's podcast is the tax treatment of entertainment expenses and expenses related to business meals after the Tax Cuts and Jobs Act of 2017. Before the Tax Cuts and Jobs Act, entertainment expenses and meal expenses were treated in kind of a similar fashion under the Internal Revenue Code, and now we're seeing that for tax years beginning after December 31st, 2017, there will be a different set of rules applying to entertainment as opposed to meals. Marty, before we get started with the changes and kind of looking at how the Tax Cuts and Jobs Act affected this area of the tax code, just in your experience as a former IRS agent, the travel and entertainment, what we call a T&E account, which would be meals, entertainment, and that type of thing, it was always kind of a focus area for an agent auditing a business tax return, I would guess.
That's I was an agent back in the 80s, and field agent, and that was a ripe area for proposed adjustments. The agent generally would not complete the audit without some type of proposed adjustments to travel and entertainment.
So that was an area where there was a lot of attention, and from what you're saying, perhaps, I don't want to say abuse, but misstatement of the correct amount deductible on the tax return.
That's true, and we're going to get into it as we get into this. But a lot of times it had to do with lack of substantiation. But whatever the case may be, or why the adjustment was necessary, the T&E proposed adjustment was pretty frequent.
You mentioned substantiation. This is one area of the code where, under Section 274D of the code, that substantiation is explicitly required, even though, as we've discussed in the past, anytime you're dealing with the service, your ability to substantiate your deduction is an important aspect of getting a favorable result from the agent in the initial report.
Definitely. It's, as you said, it's required under the statute. And, thinking back to my days when I was doing these audits, a lot of times we would propose this adjustment just because there was a lack of substantiation. In other words, the taxpayer has to be able to corroborate what his reason is for taking the deduction, and a lot of times that documentation just wasn't there.
Okay, now let's begin by taking a look at first entertainment, then we'll talk about business meals, because entertainment really is the area where the biggest changes have taken place as far as treatment of entertainment expenses. And we're talking about entertainment expenses. We're generally referring to expenses related to providing either entertainment, amusement, recreation, things of that nature. You're taking a client to a baseball game, but it also, in some cases, as we're dealing with maintaining entertainment facilities, like a company yacht or golf course or whatever you might have there. I don't know. This it leaves your imagination run wild, I guess.
And as we were, doing our research for this and are getting prepared, we saw a lot of times the mention of bowling alleys, company bowling alleys, which I'm not aware of any companies that have bowling alleys.
Well, not too many have yachts either, but
No,
you know
that's true.
that's in the general category of entertainment. Now, the old rule was, when we talked about the old rule, we're talking about rules that applied prior to the Tax Cuts and Jobs Act, basically tax years after 2017 would be under the new law, and tax years 2017 and prior would be under the old law. Under the old law, there was a 50% limitation on entertainment expenses, but you only would get those if you could meet certain other tests. Now, one of those tests was that the entertainment expenses be directly related to the taxpayer's trade or business, and that was called the directly related test. And under that test, the entertainment must either occur during an active business discussion or in a clear business setting, and be directly related to the furtherance of the taxpayer's trade or business. Those are kind of verbatim out of the regulations, but basically it was required that you could not just be, under this test at least, looking for a general expectation of deriving business from entertaining this client. There actually had to be a more specific business discussion in regard to a bona fide business transaction. Of course, that required that the taxpayer or the representative being present during the discussion. Couldn't just hand off the tickets, but it had to be more than a general expectation that you're driving business from this particular discussion. Now, that would imply that you're discussing a specific transaction almost.
Under the directly related test, that's how it worked. In other words, you had to engage in some type of business meeting, and as you said, there had to be a bona fide
But more than just creating goodwill between you and your client contract. But there was a second test, which is the associated test, where it was a little bit looser in terms of the requirements.
Yeah, under the associated test, in order to satisfy that test, there's two elements. The first one is it had to be associated with the active conduct of the taxpayer's trade or business, and it had to be directly related, some type of bona fide business discussion. But the criteria, or it seems an easier test to satisfy versus the directly related test.
And I guess the regulations make clear that this included what we might call goodwill entertainment, where you're not really talking about a specific transaction, but just trying to build goodwill toward future business relationships.
Yeah, if you couldn't meet the goodwill, the quote-unquote goodwill part of it under the directly related test, then you could arguably meet it under the associated test.
Okay, now, so we had these two tests, and by the way, the directly related tests, the associated tests, are still applicable when we're talking about business meals, but this was the test that applied. Generally, one of these two requirements had to be met in regard to entertainment expenses for tax years that predated the Tax Cuts and Jobs Act. But now the law is that even if you would meet these tests, entertainment expenses in general are not deductible.
The entertainment expenses are not, the general rule is they're not deductible. There are some exceptions, but entertainment expenses are no longer deductible with certain exceptions.
And what we're talking about here is, of course, your entertainment at a sporting event, a theater, or perhaps even taking somebody hunting or fishing or on a vacation, or out of the night on the town. there were also entertainment expenses related to the maintenance of facilities used in connection with entertainment. And again, we're talking about that company yacht or hunting lodge, or perhaps the bowling alley that you're wondering where the heck that existed. Or maybe a vacation, a home or condo maintained by a company. Those facilities, when they were classified as entertainment facilities, not deductible under the old law, and no longer deductible under the new law as well. So not really a change there, but no deductibility for maintenance costs related to facilities. That doesn't mean, though, that you can't necessarily deduct costs that you incur at the facility. For instance, you might spend money on a meal that could meet the other requirements that applicable to business meals and be able to deduct that. But the maintenance cost on entertainment facilities is not deductible. Now, club dues and memberships, we're talking here about country club dues, athletic clubs, maybe even an airline club or hotel club. And in this case, those membership fees are not deductible. But again, there might be expenses that you spend at the country club related to business meals or something else that is separate and apart that could possibly be deductible. But the meals are separate, the dues and the maintenance fees not deductible.
That's how it works, and that's important because for purposes, as you just said, you would want to separate the costs. In other words, if you have costs associated with the food, you could get a deduction or be entitled to a deduction. It's still a 50% deduction, generally speaking. But if there's a way to separate those costs from the facility part, then...
Well, that's another issue that we see also maybe with somebody that takes a client to an athletic event, maybe goes to a super box. You got the cost of the ticket, you got the cost of the rental of the box, and you've got maybe the meals or food and beverages that are supplied during the event, and you get one bill. You really have the burden of separating out the meal part, because the rest of it, the entertainment part, under the new law, and generally speaking under the old law, is not deductible.
If there's a way that it could be separated out, and you could document it, you could support it, that part, the meal part, the food part, is deductible.
Okay, now, we also had to mention that we have to put this in context, that the same expense for two different businesses might be treated differently. For instance, if I'm a theater critic, I buy theater tickets, these rules don't apply to me. That's an ordinary necessary business expense of being a theater critic, as opposed to taking a client as a lawyer to a theater event and trying to deduct the cost of the tickets.
That's another example where it is deductible. For example, let's assume you have a dress designer, and the dress designer has a fashion show. They want to introduce new designs to store buyers. That's not considered entertainment. It's an ordinary and necessary business expense.
And 100% deductible.
And 100% deductible.
So we ought to distinguish that. Another interesting situation, as a Penn State graduate, I wish I'd known that this was in the law, but even as a tax attorney, it was kind of news to me when they changed the law, that under the old law, you could make actually a charitable contribution, Marty, to your alma mater, and if that also allowed you to have access to tickets to sporting events at that institution, you could get an 80% tax deduction, not for the tickets, but for the charitable contribution that you made to be able to buy the tickets. Now, the tickets under the new law are not deductible, but now, and under the old law, the tickets were under the 50% rule, I would guess, in certain cases, but you also got the 80% of the charitable contribution. Now, charitable contribution no longer deductible at all, and the ticket's not deductible either.
And you Penn State.
Boo-hoo-hoo for the big football programs and other college athletic programs throughout the country, I guess.
And you Penn Staters, you love your Nittany Lions.
But we'll go anyway. We don't need a tax deduction for that one, Marty.
That's right.
Okay, now, sometimes we find that people make business gifts to their clients. And generally speaking, the IRS is going to treat a business gift as entertainment, which would make it non-deductible. But if it's a gift of a food or beverage that you're intended to consume at a later point, then that comes under the business gift rule. And that limitation is, what is it again, $25?
$25 per recipient per year.
And it's funny, we were talking about this earlier. We've been at this for a while, but that $25 limitation has been in the law forever.
It's been in the law forever, and as we were talking, I'm not sure, how much, what kind of gift you could get for $25.
Starbucks, large, what is that called? The grande?
Grande.
I don't speak the Starbucks language myself, but if I did, I would probably get a latte, and that's $25?
Well, not yet, but
it will be soon, I'm sure. But that limitation of $25, that's been in the law forever, and inflation being what it is, it's probably time for an adjustment. Okay, entertainment. Now, we just talked about entertainment as it was adjusted by the Tax Cuts and Jobs Act, and basically what we're seeing across the board is that the cost of entertainment as we are entertaining our clients is no longer deductible. The cost of entertainment facilities, that deduction has gone away, but that was not a change. That maintained the old law. Club dues, not deductible under the old law or under the new law. There is one exception there as far as dues. I just want to mention that dues and membership fees to professional or public service organizations like the Kiwanis Club or the Rotary Club, they're still deductible as long as that club serves a business rather than an entertainment purpose. So if you can justify the deduction for membership fees to those type of organizations, that's not affected by any of these rules. Now, and we just want to look at the rules as they apply to meals, because there has been some changes there that we have to take note of. But the old rule was basically that business meals were, the cost of a business meal was 50% of that amount was deductible, as long as you met either the active business or associated test that we talked about earlier, and that still is the rule. Of course, the IRS has made clear that you can't be extravagant with that type of cost, that it has to be ordinary and necessary, and that was always kind of the rule anyway, but there's a recent pronouncement that makes that even more clear. But other than that, as far as business meals, the rules haven't changed in regard to your deductibility of a business meal as it's associated with taking clients to dinner and that type of thing.
And you first have to determine the amount that would otherwise qualify for the deduction. Once you have the amount, then you could apply the limitation, which is the 50% limitation.
Well, how about if I throw a tip on there? How does that work?
Yeah, tips and taxes. You take again that's the gross amount, and you're then limited to the 50%. So it's basically the full bill.
Transportation, what would you say about the transportation costs?
I would say if you could separate it out, the cost of the transportation to and from the meal is not treated as part of the cost and is not subject to that limit.
Okay, now, just some illustrations of how this rule works in practice. There are, let's just talk about particulars. There was something that was in the old law that dealt with food and beverages for employees that were classified as a de minimis fringe. The old rule was that if it was de minimis, and we're talking here about maybe providing coffee or water or snacks to employees on the employer's premises, the old rule was that it was fully deductible. The new rule is that it's 50% deductible, and after 2025, the deduction is going to go away entirely. Maybe you could just expound a little bit. What is the de minimis fringe? What's the definition of that?
Yeah, the de minimis fringe, and number one, you're looking at the amounts involved. Number two, you're looking at the frequency involved. If it's just like a periodic expense, arguably it's a de minimis fringe. And if it's, like you had said, a typical illustration is you have coffee, water, snacks, you have donuts, maybe once a week you serve.
Well, if it's immaterial in cost or immaterial in terms of frequency, then that might qualify. It's kind of a facts and circumstances test. But I guess the important thing there is that the rule has changed a little bit, well, significantly, in going from fully deductible to 50% deductible till after 2025, not deductible at all.
Right now, that's how it stands. Whether it'll change down the road, we don't know.
Now, another situation where we are dealing with the food and beverage type of deduction is where the employer might provide meals for workers who work overtime, or maybe even maintains a company cafeteria or dining room. That type of expense was under the old law fully deductible, but now under the new law only 50% deductible. And again, the deduction for that type of expense will go down to zero after 2025.
After 2025, as it stands right now, it's not deductible.
So from 100% to 50% to, again, to nothing. We talked about the rule as it relates to business meals with clients and prospects. Just to reiterate what the IRS has clarified recently, the expense has to be ordinary necessary in addition to being either directly related or associated with the active trade or business of the taxpayer. Can't be lavish. The taxpayer or employee must be present. Food or beverages must be supplied to a potential or current client. And the food and beverages have to be separately allocated from any entertainment that was also paid for at the same time. Now, employee meals that are incurred during a travel status, what's the treatment of those under the new law and the old law?
Under the old law, employee meals while away from home, that was 50% deductible. Under the new law, it's unchanged. It's still
same thing.
50%.
And of course, we're talking about employee meals that are ordinary necessary while they're traveling away from home. So we have, generally speaking, as far as business-related meals, the same maintenance of the 50% treatment that we had under the old law. For meals provided for the convenience of the employer, we're seeing that the deduction is now going down to 50% and then zero after 2025. Same for food and beverages classified under the de minimis fringe rule, and employee travel maintains at 50% before and after the law changed. Now, exceptions are really notable here because in certain cases they will provide an exception to the otherwise limitation on entertainment or meal deductions. and in some cases allow the deduction to exceed the 50% limit and be alternatively 100%. So let's talk about those. We already mentioned one of those, that food or beverages furnished on the business premises, the cost of maintaining a company cafeteria or paying for meals that are served to employees who are working overtime. They are deductible up to 50%, and as we mentioned, that's a change, and after 2025, no deduction at all. What about entertainment treated as compensation?
Yeah, entertainment treated as compensation is unchanged. It's 100% deductible. A typical example is you have an employer, he rewards an employee and the spouse for, let's say, an expense-paid vacation. However, in order for the employer to deduct the 100%, you have to treat that expense as compensation wages. Or if you
In other words, you have to put it on a W-2
you have to put it on a W-2.
or a 1099 if it's an independent contractor.
That's how it works.
All right, now the corollary to that is something called the reimbursed expense rule. Now, the reimbursed expense rule is really an allocation of the restriction or disallowance rules to the payor of reimbursed expense. I'll just explain what I mean. Under the current law, this will basically apply more to independent contractors and their clients, where the client reimburses the independent contractor for expenses, which might include meals and perhaps entertainment as well. Now, the way this works is that the logic is that there should be only one disallowance of entertainment at one level. So the intention is that in my example, the independent contractor would receive the reimbursement and get a 100% deduction on their tax return without limitation, where the payor, the client who reimburses for those expenses, would be subject to the same limitations that we've talked about as far as meals or entertainment. So again, we're allocating the entertainment disallowance rules at one level, so it doesn't apply to both taxpayers in that situation. And again, the reimbursement expenses are deductible by the payee 100%. Now, I am concerned about the holiday parties and the summer picnics and all that stuff. Traditionally, we've had that company softball game, and is that going to remain deductible or is that not deductible?
You could relax.
No.
The holiday parties, the picnics, that's unchanged, still fully deductible.
Okay, so that's an exception, and of course there is a proviso that if you discriminate in favor of highly compensated employees, this exception will not apply. So if you just have a party for a summer picnic for the partners and not the associates and the administrative people, the rule would not apply to you. But otherwise, recreational activity expense for employees paid by employers, 100% deductible in that case. Another exception is expenses related to employees, stockholders, agents, or directors' business meetings. Those types of expenses are exempt from the entertainment disallowance rules, but still subject to the 50% deduction limitation. That's unchanged from the old law, and is another exception that we see to those restrictions. Now, what about expenses attending a business meeting or convention as it relates to certain exempt organizations?
That's unchanged. That's still 50% deductible.
That's kind of a narrow limitation, but an example of that would be an employer provides lunch for a meeting with a real estate board, which is exempt under Section 501A. That's unchanged, and 50% of the amount is deductible. A 100% deduction is allowed if you are providing goods and services and facilities made available to the public. We're talking about entertainment or meals that you're making available to the public. Just to restate and emphasize that that's not the type of thing that we're talking about in this context. One of the examples is a company offers complimentary coffee to the public in its lobby, so you get the deduction for that. Also, if you are selling entertainment to your customers, the cost of producing a nightclub act paid to the employees, the costs maybe compensation to employees of the nightclub. If that's your business, you get 100% deduction for that as well. So we have the general rules that we talked about, and we also have highlighted the exceptions for food and beverages furnished on the business and premises. That's a 50% deduction. Entertainment treated as compensation to the employees by the employer is 100% reimbursed expenses, 100% deduction. The providing holiday parties or recreational activities, still 100% deduction. Expenses related to stockholders' meetings or directors' meetings, 50% deductible. If you have expenses related to attending business meetings or conventions of certain exempt organizations, 50% is deductible. Goods and services made available to the public, 50%, or excuse me, 100% in that case. And if you sell entertainment to customers, 100% deduction as well. Now, finally, Marty, as we mentioned at the beginning, at the outset, that they're under the code, under 274D of the code, there's really a general prohibition against estimating expenses in this area, and the taxpayer must substantiate those expenses by adequate records. So maybe you could just expand on that a little bit, because that is and has been an important requirement to sustaining deductions in this area.
Yeah, and it's under the code, as you had said, 274D. So, and in your typical audit, so the taxpayer would give a statement, or the accountant or the attorney would give their explanation to the auditor. But then the next step is actual substantiation, and you have to have adequate records. So adequate records would be the amount of the expense, the date, for example, the description, just some notes as to, how it's related, ordinary and necessary. So it's not enough for the taxpayer just to explain. There has to be documentation, there has to be backup, and as much detail as you could give, the better it is.
Yeah, as we always say, that the more paper you can throw at the auditor, and the more independently created that is, the more contemporaneous it is. At one time, 274 required a contemporaneous record, but now it's just an adequate record. But all that will certainly be in your favor if you're audited for your entertainment and meal expense. We want to thank you for being with us for this edition of Marty and Ted Talk Taxes. We'll be looking for you for our next edition, and I want to thank Marty for his astute commentary, as always, today, and we'll be seeing you all next time.
Thank you.